8:20 p.m. final hour session. It is Wednesday, the 27th. We all know what's coming after hours today. NVIDIA has earnings, and I think they've got to be perfect. The market, the last 4 or 5 earnings have actually been solid. They delivered on EPS, delivered on revenue, and the stock still went down. We're sitting here near all-time highs. The S&P broke all-time highs today just by a couple of points. We had highs today at 87 with previous highs right at 64.80. We faded off a little bit off those recent highs. So, I mean, is this the run up because of NVIDIA climbing and growing? What's the market looking like today? Let's dive into everything. Here is the heat map and watch list on the day. Right now, we have about 60% of the S&P advancing. Not a lot of bright green. We do have some energy highlights looking at the heat map. So energy highlights, a lot of green in energy, oil and gas. XOM, CVX up a little bit. NVIDIA flat, literally 0.01%. We have some software applications in here doing okay, but Mag 7 pretty calm. Let's go Mags. Looks a lot like the QQQ. Okay, take a look. We had a high from July down to August 1st, higher high, lower high, or I'm sorry, high, low, higher low, and we're still sitting at a slightly lower high with NVIDIA earnings coming tomorrow. This looks an awful lot like the QQQ right there. July 31st to August 1st, higher high, higher low. We still haven't hit the 50-day moving average. I think we get there. I made this, bold prediction today that we're going to hit the 50-day moving average by the end of September. It's not that hard. The market has to drop 2 to 3%. Question is, are we going to drop 2 to 3% in a day, or are we going to just stretch, go sideways, go flat, and then the market just goes sideways, and this 50-period moving average just catches up, and finds it that way? That makes sense? So we can either see, prices go higher, and this moves up more, and then it ends up coming back down to it, possibly breaking to go lower, or we have something where NVIDIA, which was interesting that we've seen for the last 5 earnings, push price lower. Look at this last earnings print. This last earnings print, we have earnings here, pops up, fades in 2 days. Earnings print here, pops up for the day, fades hard the next day. Earnings print here, up and fades in 3 straight days. Earnings print here, sideways, fades in 2-3 days. Earnings print here, this is the last one that we actually saw it go up. This one was up briefly and then went sideways. So, we're sitting here with just what I see technically overbought conditions and divergence. We'd have to have a stellar earnings. The forecast is estimating earnings at 1.008, revenue at $46 billion. We delivered at 44. We're estimated at 46. I mean, the trend, 39 delivered at 44, right? Estimated 38, delivered 39, estimated 43, delivered 44, estimated 46. I mean, it probably will deliver. But what happens with this stock is the law of large numbers is getting harder and harder to compound at the same gains it's been doing. This is a heck of a ride on NVIDIA. I just think that we're going to have a lackluster delivery. I think the markets could see, beats on top and bottom estimates. Maybe it's good for a gap higher, but that gap higher probably fades by the end of the month. We also have core PCE, which is on Friday, unemployment claims and GDP on Thursday. If we go to the Bloomberg calendar and have a look at the unemployment claims expectations, let's see what Thursday, Friday looks like for major news. Here's Thursday, Friday. Let's see here, 8:30 on Thursday, continuing jobless claims. And this is Thursday. Okay, so we've got core PCE prices, corporate profits, GDP, price index, GDP sales. So this is Thursday, initial jobless claims. Are we going to have a lower initial jobless claims? GDP, are we going higher for the quarter? Previous was negative 0.5, forecasted for 3%. Again, we'll see what the print is in the morning. NVIDIA earnings comes out after market today. You go into Friday's trading, core PCE to wrap up the month. It's 8:30 a.m. We're looking at a month over month at 0.3. I'm just telling you, inflation's probably not going lower. Is inflation going to be roaring away from us and ripping away, and we're going to have hyperinflation? Probably not. But global PMIs are going up. Inflation's probably going higher. Tariffs are now, you're starting to see them reflected in prices. Prices are going higher. This is a agenda that is all about growing. Okay. What is happening is the US is pretty much dead set on trying to grow through this stall, grow through this slowdown, stimulate and run the economy hot, have the Fed jump in line and join the fiscal side, which is we're going to spend money, we're going to add to our deficits in order to grow and leverage what we have in the system. So if the Fed will accommodate that by cutting rates, I mean, a lot of people are arguing that it's a terrible time to do it. Why are we cutting at all-time highs? Well, the labor market's probably the weakest thing right now. The labor market, what we'll find out more that first week of September is, are we seeing real jobs coming into the economy, or are we finally rolling over unemployment? Our jobs numbers for non-farm payroll have been really bad. The revisions have been even worse. Let me find, let me go here. If we go to the jobs numbers, let me go this guy. Yep. So we'll go to some employment data here. Give me 30 seconds. And sitting at 6480.25 in the SPX. My 0DT levels on the day, we just had a nice steady move. We had 3 for 3 today on daily profit play. And it was a pretty good variety. We did a bull put spread this morning that made some profit. We did a reverse iron condor that made some profit. And we did even an iron condor that made some profit. So we had an iron condor pay us, we had a reverse iron condor that paid us, and we had a bull put spread that paid us. So 1, 2, 3 for 3 on the day. Ended up making about $1.45, I think, in credit. So $1.45 per contract, which is a nice little win. And I'll take that anytime, obviously. And then, big news tomorrow, whether or not we see prices, blasting higher or stalling or fading or whatever. So let me go to this. Let's look at some employment numbers. Okay. Adrian, I'm seeing there. I do like prediction you made yesterday. NVIDIA beats earnings, tops and fades. Probably. And really, the market makers are looking at like a $10.50 to $11 move. It's like 10.66 in the broker platform. So if we go to NVIDIA, take a look at your market maker move. So you can pull up any option chain. Tasty has it. Thinkorswim have it. A lot of these brokers will show the plus or minus. Go to Friday's expiration. Okay. So August 29th, 2 days out. And you can see here that the market makers are anticipating a 10.48 move. So the I've calculated out about 15 average earnings reports, and I'm looking at an average move of about $12.66. So I wouldn't be surprised if we beat a upside or downside. But I'm expecting to see about a $12 to $13 move. Now, I also take this one step further with my earnings plays. I look and see, not only do I have the average earnings, so right here in earnings history, we have about a 6.72% average earnings print. Now, I went back and I'm looking at a trade for my newsbreaker service, and I'm trying to fade this like 12 to 14% move. That's a big move in NVIDIA during the 2023-2024 run. If we hit those levels, that's going to put us up to like 200, maybe 205. And I'm looking to try to fade that with a very high credit. It's defined risk. I'm looking at like getting filled for like $6 or $7 credit to risk $3 to $4 of risk. But I'm going to, price has to break above $200 for that to happen. Now, the average move is about 6.7%. That's where you get the 1266. Now, on top of this, the average at 7%, let's just see how often we've gone to 7%. So how often have we gone to 6.72% up or down? It doesn't really matter. Let's go back like 10 earnings prints. Okay. So if we wanted to say, not just the 2-day, but let's go out like one more week and say into September 5th, that is out 9 days. So I can take this and cut this thing off at 8 days and say, how often have I at least hit the expected move on NVIDIA? Okay. This one did not. This one did. We got to 8.47. So it hit that 6.72. This one did actually day 5 and day 8. It did. So that one does. This one does at the day 8. It's down to 14. That one does. This one, 7.45. It does. It does. It does not. It does not. It does. It does. It does not. It does. It does. It does. It does. Okay. I mean, we can keep going here, but you see that a lot of times it's able to hit the expected move, right? So this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 times out of 16. So we have 12 yeses and we have 4 nos, which means if you're trading NVIDIA, being long this option is usually a pretty good play because we should at least hit that expected move. The problem is we oftentimes don't exceed, right? Like if it's averaging about 7%, it might take 5 to 8 days to get there. So I think the smarter trade is rather than trying to play this thing out to Friday, is going out to next week. Okay. Going out to next week and seeing, okay, can NVIDIA going out to September 5th hit the expected move? Well, if the expected move is 1233, okay, and that 6.7% is around 12.66, let's see if I could do maybe $10. This is 181. Could I do like the 190 by 195? Could I do the 172 by 167? Like this trade right here is honestly not a bad trade. This trade cost me $2.45. And I'm going to compare this between, 8 days out and possibly one more expiration out further. But this trade would only cost me $2.45 to make $5. Okay. So I can make like 100% gain in this trade if I let it go all the way to expiration. But I'm going to see what the difference is between this strike. So let me take a screenshot of this one and then going out to maybe one more week. Okay. So I go out one more week. This is Friday, November. This is non-farm payroll day on Friday. Let's go out one more week to the 12th. Okay. So I got the same strikes. If I move this trade out a week, now I pay $2.70 to make 5. Okay. But the move is now like $1 and change more. It's like $1.30 higher. So I'm going to pay a little bit more for that. We go out one more week, go out to the 19th. Okay. Now the 19th, if I were to move this out, I'm paying $2.90 to make 5. Now it's not that bad, but are we going to stay sideways for the next 23 days on NVIDIA? Maybe, but if I went up, let's say to try to make 750, to make let's say 750, I pay $4 to make 750. I'm risking a little bit more than I have in profit potential. Okay, but the probability that this thing can hit the expected move is pretty high. So going out $15, can we tweak this a little bit? Maybe I can go 170 by 165. Okay, that puts me at 181, gets me down to 166. So that puts me up at $4. This one, 181, gets me up to around 196. It gets me up $6. I'm only paying $3.30 to make 750 and make 5. Let's see if we can make more. This would be $6. I pay $3.50 to make 6. I pay $3.73 to make $7.50. So I'd say this is pretty even. I'm willing to take this trade right now. This would be something I can issue out for newsbreakers. If you want to trade directionally with me, I'll put this in as a newsbreakers trade. This one's out to the 19th. Can I get this 376 to give me like a 30 to 50% winner? Okay. So yeah, I don't know. I'm going to take the trade. Let me see if I can fill it here for like 375. That's my max risk on the trade. So that's exactly like 1-to-1. I'm not trying to go after 100% here. If I can at least get paid 100%, that's great. I'm just going to try to take a 30, 40, 50% take profit to increase my win percentage. So 376 just got filled. Okay. So I'm in the trade. I'm going to make this an official trade for my newsbreaker service. And I'll post this trade right here. Newsbreakers. Deanna, this is coming at you here. So newsbreakers, NVIDIA. Okay, so I'm doing a 9/19 expiration, buying the 190 call, selling the 197.50 put, or call rather, and buying the 170 put and selling the 162.50 put. $3.76 debit. Max risk 3.76. Max credit is $7.50. I'm setting a take profit at, if I'm in for 376, Let's go after a 40 percenter. So 0.4 times the debit. I'm going to go after a 526 for a 40% take profit. Okay, so that trade is in. Okay, so adding this one to my newsbreakers, NVDA, today is the 27th. I'm going out to the 19th. So I'm giving this trade some time to work. And I'm also incorporating non-farm payroll, inflation data, and the Fed rate cut. So we have some volatility catalysts in that 23 days that should also get the market moving and shaking for some more volatility and direction. Okay, so I'm buying the 170 put and selling the 162.50 put. So that's a 376 debit. And I'm looking for a 526 credit. So I'm going to take this trade, find it in here. There's my September 19th. I did one today for pinch point in my class day. We just finished up day 2 workshop for a masterclass series. I took a trade out to December on NVIDIA, in for 322. I've got a take profit set at 450. This one in for 376, putting in a take profit at 526. 526 for a 40 percenter. All right, so trades are in. Okay. So I'm giving myself about 23 days on this trade. The other one that I did for my pinch point scanner, we're going out a little bit farther. This one's out over 100 days, so it's more of a medium term swing. But now I've got price surrounded. Worst case scenario would be on NVIDIA, nothing happens, right? I mean, I've got a bit of a dead zone. I've got defined risk. If this thing goes sideways for the next 30 to 40 days, I'm going to be in some trouble. I'll take a small loss. But I look at this as we should have a pullback hitting this 50-day moving average, possibly pulling back to these previous all-time highs, finding some fibs from this low to high, pulling back 23, 30, 38%. Give us something through September. I think we have enough time to see these trades work out. Okay, so I need price to get back down here. If we're below 170, hitting like a 23% retracement, that's enough to probably get us paid on that trade. Okay, so a couple of those will work out both for pinch point and for newsbreakers. But that's the big trade. Like, honestly, this market is hinging so much so on what NVIDIA does. It's a huge move. It's 8% of the S&P market cap. It's $4.43 trillion sitting at these highs. I think it's time for a correction. In fact, I am so shocked that this market has just not found the 50-day moving average on NVIDIA and the S&P and the NASDAQ. And it's just timing, right? I mean, we turn into September, we roll over, we hit this 50-day, and we're talking about the market being down about 3%. Does it scare everybody? Not really. But what's enough to drive the market lower? A bad jobs report and higher inflation data and a Fed that is not super enthusiastic about cutting rates more than the pressure of cutting rates. Okay. So I want to go back and take this full circle into PCE is expected to go higher. I don't have a forecast on year-over-year PCE for Friday, but we had a previous print at 2.6. That's the year-over-year PCE headline. We had the year-over-year core PCE, which the Fed that's their preferred measurement, 2.8% core PCE. That probably pushes higher. We'll probably see core PCE up above 3%. Is that good or bad? Depends on what price does with it, But we have another round of inflation. That second week of September, we have non-farm payroll. That brings me to this. Let's go to labor data. Okay, let's go to non-farm and let's see what these revisions are. These are what have been gaining a lot of attention and probably not for good not good attention. This is probably the bad stuff. Look at how awful these forecasts and revisions have been. Okay, so we had a forecast at 111, came in 147. The previous month was revised down from 139 to flipping 14,000. Okay, if this 147 is revised down again to another very rough number, and then we also missed here, we had a 106 forecast, came in 73. So this is starting to get the attention of, this labor market is slowing. We're not seeing good job prints anymore. We're actually struggling to get over 100K, And if it wasn't for healthcare, health service education, if it wasn't for, I mean, there's really no government jobs after Doge this year. So it's mostly healthcare and it's mostly services that are doing the hiring. Tech has been laying off people since 2022. They're certainly not hiring. There's not a lot of job growth in the US right now. Now, people can have jobs, people can get jobs, but there's not really job growth, job creation. It's not like companies are hanging on to their workers. They're not firing workers, but tech is a different animal. Tech has been laying off people for the last 2 or 3 years, and it's not looking to hire. Like Mag 7 isn't hiring anybody, you know? So anyway, what we have here, it's going to be interesting to see what happens September 5th, because these last three data points with terrible revisions and really aggressive downside revisions, I mean, Trump fired somebody that probably had nothing to do with any of these numbers, you know, but you're the person that's in charge, and I'll make it so that we need to fix this. The data's wrong. Well, I think we've been fluffing the data for a while now. And now we're going to see, how much the market cares about labor, how much the market cares about unemployment rates. Okay. So if we look at the unemployment rate, it's just been persistent around 4%. So we've been down to 4, we were up to 4.1 or up to 4.2. Part of me thinks that, for as many jobs as are out there, like we're talking millions upon millions of jobs, you mean to tell me that we're just staying right there at 4.2 every single month for the last year? 4.2 seems a little questionable. you know so again, whether you believe the numbers or not, it doesn't matter. What ultimately matters is, what does this data print, what does the market do with it, and what does price action respond, or how does price action respond? And from the technical side, I know that this market can go a little bit higher. We're sitting here at 64.84. We're right back up towards today's intraday highs, which is right up to some fresh highs. This is a blank workspace, so let me get this one here. So these are the previous highs back in, we had the July 31st high, fell 3+%, came all the way back up, broke the highs, stalled at 64.80. Jackson Hole came right back to 64.80. We did end up sweeping the highs right here. So taking out the highs today, chances are we're probably not coming back to this low by the end of the week. So NVIDIA earnings, after market, tomorrow and Friday is where price action plays out. It's probably easier for the market to stay green. This would be the point where we can stay positive, right? So we can stay positive right here. As long as we're above this level by Friday, the market still clings to a green candle. If we come back down and we break the highs, but we also break lows for the week, well, we probably won't take out this low from last week, but we could certainly turn red on the week by the end of the week. I still think this 6,500 zone is really, really critical to see some resistance. This technically goes out to the 9/29 expiration. I think that's the end of September. It might be the 30th. I've got 26. That's the final trading Friday of September. So the September 26th is the end of quarter. So that'd be the 26th. So the 9/26 expiration, it is the Q3, right? The end of Q3. There's a massive call wall at 6,500. So, I mean, it's been impressive. Like, we've tested it so much faster, right? We've been testing it so much faster that we're just sitting right up these highs. So all I'm saying is, I think the market's going to pull back. I've been telling traders this now for probably the last month. Like, look, I think there's a correction coming. I'm not necessarily bearish. I mean, look, the way that I'm bearish on this market, it's like doomsday bearish. And here's what I'm doing. I'm buying puts down here at the April lows. That's how far out I'm willing to go. If I'm going to be wrong on a hedge, I want to be wrong with like something that pays me like 50 to 1. I will show you. Okay. If I go to the futures market or I go to the SPY, I want you to see how good of a payout you can get. If this market is going to turn over and we're talking like, oh my God, it's 2008 all over again, the market's going to roll over and never come back. Look, this market is so aggressive on, just trying to stay bullish. I think that there's a lot of support here at previous all-time highs. I'm concerned if the market breaks below the 200-day moving average, it doesn't show any type of bounce. So if we come back to like the 50-day and we bounce, we're still in good shape. We come back to the 50-day again, we bounce, we're still in good shape. We watch and see how that structure behaves. We want to see that prices can still stay supported there. But yes, if we roll over and start to curve back down, you do not want to see these levels violated. If these levels get taken out and the bears are running and the bulls are dead and the bears just keep clawing back, anything below 5,700, 5,750, I'm questioning the sustainability of this bull market in the near term. Okay. So if, and I would say, like, what feels like worst case scenario for 2025? Well, we had this crazy 20% correction. We had this huge 30+% rally. And let's say by the end of the year, we fall all the way back down to these April lows. That would be a terrible year and a crazy volatile year. I mean, I'm sure Trump is going to be super vocal about, gosh darn it, Powell and the Fed, and it's everyone else's fault. But what is happening? I don't know. It's just time. It's time for the market to make a correction, but I don't think it's there. I think this market wants to buy the dip. I think it's pro growth. It's pro deregulation. I think there's going to be a rotation that will be felt, because a rotation out of Mag 7, out of high value, out of high valuation tech, and into stuff that is not as expensive. Like, why would I rotate into like a 30 to 35 times price to earnings stock when I can buy something that's like 12 to 15 times earnings? I mean, that's the argument. That is why the Russell right now, we had some of the biggest inflows we have seen in a long time. Look at the Russell. It's still making highs. It's still marching towards these all-time highs. Okay. You might want to, I mean, honestly, if we stay resilient this year and we see the Russell hit all-time highs and then some, I would be thanking the Russell for saving the S&P and the NASDAQ, because there's still risk appetite, right? If we roll, here's the deal. If we roll over a little bit in the S&P, if we roll over in the S&P and it just bounces and it bounces and it bounces and it bounces, but the Russell meanwhile is just making nice strides to the upside, that is a bull market breadth that is still resilient and in the market. Meaning, like, small caps are getting a lot of love and a lot of inflows. Larger caps are just kind of maintaining, and there's not really a bearish or a risk off sentiment trade. So we could stay resilient in the S&P and resilient in the Nasdaq, but we can see that the catch-up trade is small caps. Okay, and what would they be doing? They'd be closing the gap for, I don't know how many years you have to go back, but let's bring up a blank chart here. Okay, let's go blank chart, go to the SPX, and then compare. Okay, I'm going to throw in a comparison. So let's change this to a line graph. Okay, so S&P is in blue, and let's add in the Russell. Let's go same percent scale. Okay, let's go add the NASDAQ, same percent scale. Let's add the Dow. Oops, SPX. Let's add the Dow, same percent scale. Okay, so NASDAQ is in purple, S&P is in blue. Russell, let me see which one's my Russell? Oh yeah, I mean, there's the Dow. There's the Dow. Okay, let me change the color on the Dow. So style, let's go to orange for the Dow. So we have Qs. I'll label this here. So QQQ on top. Okay. S&P or SPY second, Dow third, and Russell fourth. This is the trade that we're seeing right now. This is small caps finally trying to catch up to large caps. The way I could see this happening and still maintaining a bull market would be that NASDAQ continues to grind higher, S&P continues to grind higher, Dow continues to grind higher, but the Russell gains and closes that valuation gap. That's what I could see. Okay. What is unlikely going to happen is the Qs come down, the S&P comes down, the Dow comes down, and the Russell still goes up. That's probably not going to happen. What would happen is these come down faster, okay, and this comes down less because it already is undervalued. So there's two ways the market broadens out. We either broaden out by those that have been performing really well, all of the high flyers, the profit gets taken, the allocations go from get out of high valuations and go into cheaper valuations. So you dump your Mag 7, you dump your high flying AI stuff, and you put it into small and mid cap trades. That's a pretty aggressive rotation that's happening right now. If that wasn't the case, then the Russell wouldn't be up 8+% for the month. The Russell has crushed it in August. So if we want to see the bull market continue, we should probably cheer on the Russell to go to all-time highs and continue. Because if all these turn over, the Russell's going to get back some gains as well. But if all these turn over, obviously things get really ugly very quickly. So a lackluster performance in the S&P and the Qs and even the Dow, but a good, healthy performance in a catch-up trade in the Russell could still maintain the overall trend. Does that make sense? So two ways the market broadens out. Either one is we catch up and everything goes up. This is the high tide raises all ships, or everything crashes, and what sucks the worst probably crashes less because it's already sucky. We saw that back in March. The Mag 7 rotated hard. A lot of stocks got beat up, but what was already kind of beat up and down, underperforming, just didn't have as bad of a drawdown. I mean, Mags was down 30+%. Individual Mag stocks were down 30, 40, 50%. But they came back off those April lows really, really aggressively. Not all. I mean, April lows, we did not see all-time highs in Apple. We didn't see all-time highs in Tesla. We did see all-time highs in Google. We did not see all-time highs in Amazon. We did see it in Meta. We did see it in NVIDIA. Okay. We saw it in Broadcom and AVGO. So anyway, two ways the market broadens out. Either the catch-up trade where things stay bullish and we just have the catch-up trade still going strong, or they all turn over and the Russell just ends up being, performing a little bit less bad. But that's how the market broadens out. Either everything goes up together or everything falls together and what's already beat up and undervalued is just going to fall less. So I think we should all be hoping for this, that the small caps, mid caps can continue to be this aggressive rotation, and there's more inflows and there's more greed out there to drive this market higher. Okay. I still think we have to at least have a correction. I do. I think it's crazy what we've seen in the markets thus far without having at least a pullback. So, timing wise, this is why I kept talking about the timing of, this 50-day moving average. If we can get through, and I would be shocked if we get through non-farm payroll and inflation and the Fed for a month and we don't see prices at least pulling back to this is a 50-day moving average, that would be like a 3% correction from current prices. Okay. If we go higher, I think we go higher and still pull back. If we stall here, we go down, I think we still find that move in the coming weeks. Okay. So I'm not much for calling, hey, the top or the timing, but I think over the next 30 to 45 days, or even the next 30 to 60 days as we get through September, October, I think this moving average is hit. I think that this level also potentially gets tested, and we're going to see how the market shows a correction. Okay. If the market corrects in a organized pullback, that's another good way to buy the dip with some conviction and some confidence. What we don't want to see is a nasty, big, ugly candle that then has a dead cat bounce and then another ugly swipe to the downside. Because if we breach this level and start testing this 200 moving average, we better close back above this thing and try to regain those highs. The market's already up 10% for the year. Historically speaking, 10% after 20% years might be all that's in there. This market might be in just drift mode, right? But a drift to all-time highs is a lot different than a thrust to all-time highs. That's why that rotation trade, I think, could be really important, because the Russell still has catch-up. The Russell still has 8, 9, 10% to get to all-time highs. Maybe it has the ability to go higher. I think the Russell could honestly impress us. I look at my chart on the Russell, and maybe this is like wishful thinking, because I know a lot of stocks in the freaking Russell don't make money. That is a legitimate concern fundamentally. But if I look at the technicals here, okay, if that catch-up trade, look, all we have to do, if we just stay sideways, okay, let's go back. I don't know how many years we have to go back here, but it's going to be ridiculous. Let's go back to COVID lows. Okay. COVID lows right here. Okay. From COVID lows, the NASDAQ is up 175%. The S&P is up 118%. The Dow is up 76%. The Russell's up 63%. There is a huge catch-up potential. Even if the S&P just drifts, the NASDAQ just drifts, and the Russell screams catch-up, that's a lot of percentage that this thing could outperform. Okay. Does it play out that way? I don't know. I don't know. I would kind of hope that it does. If you want to keep the bull market afloat, then I think you need small caps and mid caps to catch up and keep this broad market going. If it doesn't, and I'm repeating myself here, but if we roll over and we roll over and we roll over and we roll over, these probably fall faster and these probably fall with it, just less aggressive. And this also narrows the valuation gap, right? And what would fall the fastest? Probably the most overvalued, the NASDAQ, right? So again, for the integrity of the bull market, you probably don't want to see that happen. And to what degree? I mean, if the market rolls over, it'd be awful to see the market go back to April lows again. But if I wanted to show how cheap it is to trade a put right now, how cheap it is to protect my portfolio, okay, let's put a position on. Let's look at it. Let's do the math. I've got hedges out in the futures market out to the end of the year, and they're back down to these lows. All right. So here's ES. 5,000. Let me double check. So this trade, 6,000 down to 5,250. So this is one hedge that I have out on futures. Okay. So if we see price going back down to like 5,250 or 5,000, the lows are around 5,000. I've got a lot of these hedges as well. Let me just get one individual count here. So MES, this one probably won't help. This one might help. Okay. Futures wise here, this is 4,000 to 3,100. If we revisited April lows, this one's going to pay potentially like 20 to, I think, what was it? I risk $1,000 to make $40,000. All right. Anyway, let's just price it out. Okay. I'm going to go futures. If we come down and say from 5,000 or lower, I'm going to go out to, let's go to like April. Let's see if we can get a futures contract out to April of 2026. So if I go April 2026, April 17th, can I buy the 5,000? Okay, that'd be back down near April lows. How low can I go? This trade's going to cost me $2,600. Okay, now it costs me $125. So I can put on a spread here. It costs me $125 to make $2,300. If I'm comfortable risking about $500 on this trade, I can risk $500 to make over $11,000. Now, the reality of this trade is I'm probably not going to make $11,000 because I'd have to time this perfectly and we'd have to be below 47.50 by expiration. But because it offers so much profit potential, if we come anywhere near 5,000, 49.50, 4,900, this $537 max risk could probably offer $2,000, $3,000, $4,000, $5,000 worth of profit. I don't have to hold this thing all the way to 11 grand. But if I could turn a $500 risk into like 5 grand profit, that's going to offset some risk. I mean, and I think that's not a bad hedge. So honestly, I think I might officially post this trade. I can do this in futures, but I might post this trade for my crash insurance masterclass because going out to April next year, if the market rolls over, it's a pretty inexpensive hedge to make. Hopefully $3,000, $4,000, $5,000. But again, where do we have to go? We'd have to drop all the way down to April lows. Okay, but that would help me offset some drawdown. So it's pretty cost effective. Now that's in the futures market. If we want to say, I never trade futures, Chris, well, then look at the SPY. If I looked out to April of 2026 on the SPY, so we can go either March or we can go June. Nothing's bad, but let's go 500. If I go 500 by 400, okay, for $400 on the SPY, I could have a potential $9,500 profit. Again, very little risk for a lot of reward. That $400 risk could easily pay $400, $800, $1,200, $1,600, $2,000 worth of profit. So I'm going to make a note for myself, probably issuing a trade in my crash insurance masterclass. And we'll probably do a Q1 hedge. Okay. Because if this market is maintained through the end of the year, and meaning that we don't really lose the structure of this bull market, and all we have is like a little dip and a little dip and a little dip, but it just keeps grinding higher, then nothing's bearish. And so that's why I do trades like I do in waterfall income, where I have this big margin for error and price can just keep grinding but I've got profit potential if it goes higher, profit if it goes sideways, profit if it pulls back, I still make money. So waterfall income gets me all of this like forgiveness trade, right? All this forgiveness, meaning like I'm essentially 10, 15, 20% below price, and I can still get paid on a lot of these trades week after week after week. So that's a good thing. On the hedge side, risking $400 to make 4 grand, to make two, 8 grand, 10 grand, like I think it's insurance. That's all it is. I hate to lose it, but it's worth the risk if my entire portfolio can keep making money to the upside. Okay. So if we see a big decline, I can see some good profit. If we just kind of have some choppiness in here, I can sacrifice that hedge, still reposition for the market, give myself some wide room for error, and still grind through whatever this fest is, the chop fest we might get into the end of the year. Um, I don't, I don't know what this market intends on doing. You know, everybody is so doom and gloom, and everybody's so bearish, and everyone thinks the whole economy is going to roll over, and it's just going to be a huge recession. It's so telegraphed that it's like it's probably not going to happen. The market likes to push to like those ultimate pain points, So when everyone thinks recession, recession, black swan, it's like it's what's the black swan if you think it's going to be a recession? You know, like nothing. I mean, a couple job losses doesn't make the economy roll over. If anything, it just accelerates this move into AI. It accelerates this move into doing more with less. It accelerates this move into automation and embodiment of AI. So that's the sad part is I think you're going to have like Main Street and people just getting furious with how things have changed right before their very eyes with exponential technical innovations. But the reality is, doesn't stop the markets from going higher. Doesn't stop profit margins from increasing. Doesn't stop this market from just continuing to melt up. So I don't think that the employment side is necessarily going to be a big break. I really don't. I think that what would happen is if unemployment started to get a little iffy, if we started to see that, our numbers started to trickle higher. So this would be unemployment rate going to 4.3, 4.4, 4.5. I think the data is so fudged that it's going to take, I mean, we're going to be way worse off. If we start to see this thing actually print 4.5 or 4.6 or 7 or 8, it's going to happen when job numbers are way worse than they actually are. So if we actually see the data trickling higher, then things are going to be pretty bad on the employment side. But we could 100% have a Main Street recession and a Wall Street is fine. Stocks keep going higher, markets keep melting up, profit margins are so great, earnings expectations continue to grow, multiples get higher, valuations get stretched, and it just keeps going. And what would be the major shift? I don't know. Maybe China, US go to war. There's a big shift. That's a geopolitical thing that would probably rattle the entire world. Or we have a policy shift during the midterm elections in 2026. Like I just don't see like Trump and company would they'd have to lose a bunch of momentum in order for this current agenda to not be seen. Like Trump and company are pushing so hard and so fast, they're literally pressuring the Fed to just cut rates. And Powell's cutting rates most likely in September and probably again in December, maybe again in October, and throughout 2026, Powell's gone. So, I mean, Trump and company are getting what they want. And I don't think their message is going to be, let's make the economy worse. You know? So don't overlook how resilient the stock market can be despite what might be happening under the hood. So I think a pullback is needed, but a pullback and buying some dips probably works out okay. I'm going to be very forgiving on those dips. I'm not just going to jump right in and buy the dips. I'm going to buy, very defined risk trades. You'll see this in my double up service. You'll see this in waterfall income. And that's probably it. Daily profit play maybe, but most likely double ups and waterfall. Okay. But if we get some dips, I'll take defined risk of those dips. If we're gonna, come back down to these dynamic support levels and then work our way back to these highs by the end of the year, we typically have like a re-leveraging in the markets in November, December, January anyway. And the vulnerable pocket would be February to April. That's why I'm saying if I'm looking at hedges, if I hedge through like April of next year and we see the market all the way down here again, I want that trade to be, I mean, I just showed you like $500 risk for a $10,000 payout. That's 20 to 1. Okay. That is a good hedge. I might lose $500 on the trade. But if the market keeps going higher and higher and higher, and time decay works in my favor for all the trades I have running, $500 is nothing. Okay. There's thousands and thousands of dollars to be had by just letting the market do its thing and go higher or go sideways. I'm selling a bunch of premium to hopefully have a bunch of trades come to fruition. In fact, for the week, I've closed out winners, audio breaking in and out. Give me a quick AV check, everybody. I'm going to wrap up here in just a couple minutes. Ryan, I saw your question there. You're still with Nick. Yes. I post a video every Monday for the weekly outlook. So every Monday I post a video, and then I still add to my Discord and my thread my analysis. When I post videos for TradingView, I share that with the A1 trading community. So yep, still take those trades. This week I've been closing out for a bunch of profit. This week we are 7 for 7 in daily profit play. I closed out on Project Options Edge. I have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 winners on Project Options Edge. Okay. This week on Friday, I have a waterfall income, hopefully a 65.35 SPX key level on 8/29 expiration for waterfall income. Okay. On that trade, my profit would be $1.60. Okay. Or a profit trap of $5 plus the $1.60. But I also have a risk of $8.40 if price is greater than 65.40 by Friday end of day. Okay, so I still have some wiggle room. If I go to this chart on SPX, I'll just leave this up for a sec. So, so far for the week, I've had a lot of winners. Today I took 49 trades, a lot of them just closing trades out. I issued a couple new trades. I took some trades on a video. We took some trades in Pinch Point Scanner. We closed out a winner on Pinch Point Scanner today on Nike. That was an 83% credit. So I'll take that trade. We got 23 winners so far booked in some of my services, 7 for 7 this week in daily profit play, 16 winners on Project Options Edge, getting some buying power back, raising some extra cash, and trying to reposition. This was down to about $200,000 earlier this week. Now it's up to almost 2.1. So I still have some buying power. That's good. My stock buying power, that's with leverage. So this is always what I'm using. I do have margin accounts in addition to IRA accounts, but this is always what I'm paying attention to. I never want to trade on margin. So when this is 0, I don't have any money left to trade. So that's why at this balance, I'm just under 50%. So I still have plenty of dry powder, and I'm looking for trades to hopefully, set up for me to take additional trades. Cutting in and out for a few minutes. That's so weird. Audio. Okay. Sorry about that. It should be good, man. This microphone. All right. I'll go back and review the recording. Hopefully it's okay. I think it might be actually. I got a little notice that my internet connection was a little bit weak, so maybe that's what's happening. Either way, I can try to plug into another USB for tomorrow. But hopefully audio is good enough to wrap things up for today. We'll come back and do it again tomorrow. Tomorrow's going to be Training Thursday. We have NVIDIA earnings coming out. We'll see if there's a big jump. We might have even checking here in these next few minutes. Training Thursday, then Fast Money Friday. We're wrapping up the month. We come into the first week of September with non-farm payroll, all eyes on employment. I think the market's done an incredible job of just pushing. You look at the S&P on the monthly time frame. It's been a pretty impressive run from the turning point in April. This ridiculous turn in April to May, June, July, August. I don't see September going higher without having a pullback. So could September be another, we start here. Let's say September starts here, goes down, and then finishes the month higher again. It'd still be like a bit of a hanging man type look. So I'm just skeptical that we just have to have a correction. And again, it's minor. I just want to make sure it doesn't roll over and get really nasty, because it's so one-sided with how much risk appetite there is on the retail side that I think we are getting into some pretty frothy, greedy territories. So if we go to the Fear and Greed Index on CNN, okay, we're at greed, not extreme greed. We're at greed. You go to AAII sentiment. You go to the AIIM. These are some big like macro levels. Look, right now, this is where I'm saying the pain trade is higher. Everyone is still freaking bearish. Why? I don't know. I don't know. It's just terrible timing. People, fear the worst, and I can't believe how bearish this is. But remember, this is sentiment based on probably consumers, right? Oh my gosh, life's more expensive. Inflation is happening. People are losing jobs. It's all the worry that's tied up in this sentiment survey. But what's the market telling you? You know, I mean, market's telling us that we are greedy but not extreme greedy. So market momentum is greed. Stock price strength is greed. Stock price breadth is greed. Not extreme, not extreme, not extreme. Put and call options, greed. Market volatility is neutral. Safe haven demand is greed. Junk bond demand, extreme greed. We don't have any real outliers here to be like, man, this thing is so over frothy. It's not. It's just it's the melt up that might not want to stop. It might dip like 3, 4, 5%, but it might just not stop. So I'm telling you, like, don't be surprised about the resiliency of the economy. Like, I should say stock market, not necessarily the economy. We could see that labor gets worse. We could see that people are more frustrated. We can see a sentiment shift in how you feel out there. But the economy overall, as the stock market is concerned, might not change at all. Higher highs and higher highs and higher highs. And what do you have to celebrate? Well, if you're an investor, you probably celebrate all time highs, and that'll feel pretty good. If you're not an investor, then you're pretty pissed because all you're doing is watching life get more expensive and get left behind because you can barely afford to, stay other than like week to week or paycheck to paycheck, and that's where people are at. People have been feeling the pinch of inflation and the price is going up for the last 5 years, and that's what sentiment's about. People are upset about that. I am too. Life's more expensive. It sucks. It's annoying. Everything's more expensive. Okay, but you game the system, meaning you trade the markets. It's like it's a tool designed to create crazy wealth gaps. If you look back 20 years, 30 years, 40 years, and all you had was cash to buy these dips, you're making money hand over fist. A bear market can last, yes, but the average bear market's over in like less than 2 years. The bull markets can run on average 4+ years. We had a bear market in 2022. It's now 2025. So we haven't hit the average. We could go 2026. We could have a big shift in midterms 2026 before the top really happens. You know, so just expect some volatility, but I think the market's going to persistently try to push higher and higher and higher. That's what I'm looking to trade. My my theory on that, my kind of thesis, if you will, hasn't really changed. We're very pro growth, and probably to a fault. We're probably trying to run this economy very very hot, and I mean, we haven't really seen in a while, we haven't really seen fiscal and monetary policy work together since like the bottoms in 2009, or maybe back into the late 90s. That's a powerful force. If you have monetary policy easing and being more accommodative with money supply going up, and you have a fiscal regime that is spending money like it's a crisis, those are very powerful tailwinds for these markets to head higher. So I know we're overstretched. I know we have overbought conditions on the technical side. A pullback and a pause is fine, but don't underestimate the power of fiscal plus monetary policy. Okay. Because now the Fed is getting in line with fiscal. Fiscal's been happening since 2020. Monetary policy has been the opposite because we raised rates in 2022. We deleveraged the market in 2022. And now we're looking to cut. So I'm just saying, don't underestimate that force. And it's not just in the US, it's global. Okay. What else? This week on the NAAIM, the exposure index, this also gets a little high. We tend to see some peaks in the market. This is July 2nd. Interesting, like July 30th, we were down a little bit, and the market did have that July 31st to August 1st correction. So I'm wondering if we get up here and then roll over a little bit on this. I mean, we haven't broken 100. The time we broke 100, March 13th, the market was falling, right? March and April, the market fell. So this is that correction we saw in 2024. July 2024, that was a correction we had in 2024. So if you see like a steeper correction in this NAAIM, so what we're looking for is this. If you start to see that this is going lower, this prints week after week. So if this goes lower, there might be a little bit of a hiccup in the market. If this goes lower, 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 then we're probably going to see a decent correction. Okay. I mean, you can see the comparison. Look at the bottom. So every time this thing has bottomed, we had a correction, right? As this is trending lower, this is where the correction takes place. Okay, right here, you had a correction. Right here, you had a correction, right? Like the correction's underway when this thing pivots from like 100 highs down to maybe an 80 or 60 reading. Over here, you had a correction. Over here, you had a correction. So this is a good way week to week to check this out. I would trust these inputs a lot more than the AAI sentiment. All that is a contrarian reading where the pain is at. The pain is felt by everyone thinks the market's going to be bearish and it stays bullish. That's the pain. So where are we at right now? We haven't had a pullback, a meaningful pullback since literally the bottom in April. So if this starts to go down, then I think we have at least a bit of a correction in the market. Doesn't have to be awful. It could be right back to previous all-time highs. It could be take this low, take this high, draw some fibs, find some Fibonacci support in the market. It's good enough to maybe find some higher lows and then see the market get back up. But I'll keep an eye on this one. I think this is a good one to watch. I'll post this link in the chat if you want to keep an eye on this one. This is the NAAIM exposure index. And this is something I check every week. Okay. All right. What else? You want to join me for tomorrow's daily profit plan? Let's see if we have earnings coming out in NVIDIA. If you have anything, let me know. I'll go to Financial Juice, see if anything printed on NVIDIA. Maybe it did, maybe it didn't. Wall Street has no fear, but a shocking sell-off could be lurking. Okay. Yeah, we know it's soared 35%. Bankruptcy is surprised. The pandemic's getting worse. Yes. RFK health hit pieces. All right, I don't see anything on NVIDIA right now. Dollar climb, performance today, currency strength, anything happening here? Today, CAD was stronger. Yen, euro, dollar, New Zealand weaker. CAD up. Okay. Not a lot of volatility on the currency side. Okay, so nothing on earnings from what I can see right now. And we'll see. Is anything happening after hours with NVIDIA yet? Post market's up 70 cents. Earnings are coming in. We'll see what happens. It'll pop up on my stock twits or my apps or whatever. I'll get some data here. Anyway, tomorrow's another day. If you want to join me for Training Thursday and my daily profit plan, all are welcome. Weekdays 9 a.m. daily profit plan. Weekdays 9 a.m. Eastern time. I've got 2 links I can share. A couple ways to join me. So this one. So there's that link. And then if you join my Telegram, you could join my Telegram as well. Okay. So live trading tomorrow morning, 9 a.m. Eastern time. We'll tackle the day. I'm watching a trade on waterfall income for SPX. We'll watch and see what happens with NVIDIA. I've got a trade on newsbreakers. I've got a trade on pinch point. And we'll see how that plays out. What else? I think that's it. Price to perfection. NVIDIA must be perfect. I could just see the market timing as if we get to these highs by the end of the month, which is Friday, end of the month is last trading day is the 29th. Maybe we're sitting at these highs and congratulations, you had a good month through August. But September, October, I don't think that window is going to be perfect. I think that window is going to be reality. Rougher job numbers, inflation prints, like all these things that are like a concern on the economy side, a concern on the consumption side, a concern on the citizen side. I could see that being, yes, the Fed might cut, but they might cut reluctantly. Maybe it's a hawkish cut, right? Where they don't want to cut, but they're going to because they realize like the labor market's starting to slip away and getting a lot softer. If non-farm payroll on the 5th is another big miss, I think we should have legitimate concerns that non-farm payroll and revisions are showing like, look, the U.S. has clearly slipped into a rough job market. Okay. All right. Jim says it's dropping. You looking at a video here? I've got a video at 182.50. It's up 90 cents. So after hours, I mean, let's see if there's anything on FinViz. And again, we might not see it in the time that we're trading. Palantir, holy shnikes. Palantir dropped a lot today. Down 2.5%. Let me see if I can find anything on NVIDIA with earnings. 410 Market Watch. Edges lower heading into earnings report. I'd say that's not true. It closed with a tiny little red indecision candle today, plus or minus $10 to $11 on the day. Market makers expecting $10 to $11. My average earnings print's 1266. So I'm looking for about a 12, probably anywhere between like a $10 to $13 move on NVIDIA, up or down. Yep. So now it's down. I must be getting Jim's lag here, or I'm just seeing this in real time. So now it's down. 177 post, 176 post. Again, this doesn't mean anything. It doesn't mean anything. What matters is what's happening. Okay, revenue up 32%. All this hitting the news wires right now. Let's see, data center revenue up 56%. What else? I just had 10 news breaks right there. Gaming revenue up 49%. Automotive revenue up $586 million. Gaming revenue, automotive revenue. EPS was 105. It was estimated $1, so EPS is a beat. I'm looking for revenue. Data center revenue 41.1, 108. Net 26.42 billion. Did we have a huge miss on earnings? Do we have a huge miss in revenue? So that's a miss in revenue. We were forecasting like 46. It comes in 26. That could be, no, I think you're right there, 46.7. So we beat on top and bottom. We beat, from what I'm seeing, we beat earnings per share, and we beat our revenue. But again, we've had this happen where it beats and the stock falls. It beats and the stock falls. It beats and the stock falls. So it wouldn't surprise me. Right now it's down about $5 or $6. This is all post-market stuff. Let the market do its thing. It's going to gather. It's going to be trading off hours, and then we'll come to the markets tomorrow. Is NVIDIA higher or lower? And what is that doing to the futures market? This is the one thing I want to watch too. Take a look at futures. Is this moving on NVIDIA right now? Okay. Right now we're already down about 0.25%. So NVIDIA's earnings is starting to move things lower. That little tick of, $6, $7 on NVIDIA is dragging the market down. Around 30 points. So it's not done. This is just a fraction of what we have to deal with for the next, 17, 18 hours until we come back to 9:30 tomorrow. So it could be higher in the morning. It's all so early. Just let price be price. Okay. So we'll see what happens. I think technically we need to have a correction. I'm hoping that we're not sitting here at the same freaking all-time high or higher coming into the end of day Friday. The trade that I need, this is more short-term for my waterfall income. I would like to see price not get above 65.35. That's just one trade. I know it doesn't really matter, but for me it does. $1.60, potentially up to $660. If price is here and we can get this NVIDIA earnings out of the way, that will kind of we'll see a volatility crush after that. If price is struggling to go higher, this trade is probably going to trade for more credit. We pulled in $1.60. I'm going to try to get this thing paying us, $2, maybe $3 a profit versus $1.60. So we'll see. If it tanks from here, then it's going to be an easy 160. And then we have two other trades into September that will look even better for another like $125 and $230. So that's the near-term stuff for me. And then it's a correction that I planned on, seeing for the last couple of weeks. And we're finally maybe getting the rollover here with NVIDIA, dragging the market lower if it does. And then, going into September, probably having some tougher headwinds with the labor market not impressing, inflation not impressing, and then the Fed reluctantly making a cut. And we'll see what Powell says during the press conference. Okay. So, all right, let's come back and do it again tomorrow. Join me at 9 a.m. Daily profit plan. Let's tackle the day. Let's win the day, and we'll do our best. So trade the indexes with me day to day, weekly swing trades in the indexes, trade some major catalysts. I got the NVIDIA trade out today. Double ups. I didn't really find a good level today. My just prices have been so slow going into this catalyst. Pinch point. I've been doing a masterclass all week long. We took a lot of trades today on pinch point. I have new trades on pinch point. 1, 2, 3, 4, 5. I've taken 5 new trades on pinch point this week. We just closed out another winner today. So Nike closed out for an 83% credit, and we're up to 83% winners on pinch point. Doing pretty well. So the process continues, and we'll keep grinding. Crash insurance, I'm likely going to add a trade for a Q1 insurance trade tomorrow. So if you're in my crash insurance masterclass, I'll just issue that trade alert for you, and you can follow it if you want to take it on like SPY or Qs or the futures market. I'm looking at where to get the most bang for my buck. And then Project Options Edge, we closed out a ton of winners. We closed out 16 winning trades this week for profit. So those are all pretty good. And then I do have to give this. I had Ken reached out to me. Ken, if you're watching, I'm going to send you my full guide and my quick guide links for my practical options. That's just bonus education. Trade the market up, down, sideways. This one's $27, and trade the market up, down, sideways. 13 of my favorite strategies with a strategy guide. This one's $4.97. So just good education. I built practical options with the intention of, if I can teach anybody that knows nothing about options how to trade some options without all the silly names, without all the stupid learning curves that everyone thinks it's so difficult to learn, I try to make all that stuff really simple. So let's apply it into the markets. Let's make it practical. That's what this practical options course is all about. Okay. So if anybody's interested in that, you can just hit me up in one of these messages or hit me up in Discord. But these are always available a la carte. Okay. All right. Daily Profit Plan tomorrow. I'll see you then. 9 a.m. Eastern time. Come join me. We'll be live on Zoom and live on youtube.com/financial wars.